Price hikes did not deter customers from grabbing their Happy Meals last quarter. McDonald's saw global same-store sales jump by nearly 9% in Q3, with digital making up 40% of its total sales. CEO Chris Kempczinski told investors the macroeconomic environment is unfolding in line with our expectations for the year, and we continue to deliver convenience and value for our customers, end quote. Peter Saleh, who is the BTIG Managing Director and Restaurant Analyst, joins us now. Chris, thanks for taking the time here. Peter, getting names mixed up here. Just excited about what Chris Kempczinski is saying on this call. My goodness, the Golden Arches. So ultimately here, broad strokes, your takeaway from this quarter and how it is mirroring with what we're seeing on the macro as the CEO was talking about.
Yeah. Great. So thanks for having me on and good morning. So look, I think McDonald's had a good quarter, but definitely weaker than they've had in the past several quarters or year. I think the couple takeaways from the call was they, in their prepared remarks, management talked a lot about macroeconomic headwinds. They talked a lot more about value and the importance of value. And you can see that as they start to pivot to more value offerings, more value bundles, not just here in the U.S., but on a global basis. So clearly something is shifting. Traffic in the U.S. turned negative. Their comps were all boosted by menu pricing and the average check. But there is definitely a shift in the consumer in the U.S. That is happening, and they're responding with more of a value offering going forward.
So, Peter, what does that mean then for results, do you think, the current quarter and then looking out to 2024?
Yeah, look, so I think they'll be able to win and take share. I think the entire industry is pushing more on value, but it's just going to be more competitive. You're just going to have to drive more transactions with a lower check. Maybe you give up a little bit of margin to do that. That is yet to be determined how deep the discounts are. Keep in mind, McDonald's has been discounting for a significant amount of time now, for maybe a year or so, but really through the app. So you can get a 20% off your entire order if you go through the app. So the discounts are available. I just think the level of advertising behind them is really going to start to kick up in the next couple of months into the early part of next year.
And that advertising is where we've seen them lean into nostalgia, cough, cough, grimace. But at the end of the day here, too, it does come back to this kind of this expectation that we've seen from the economy going back into and going rather forward, I should say, into 2024. We've been discussing with analysts and economists about their expectations for any type of shallow, mild, or even more deep recession. Is recession good for burger sales at McDonald's?
Look, I don't think recession is good for anybody in this space. I think the one thing that this space has a strong correlation with is job growth and income growth. And we're still getting a lot of job growth and income growth. So, look, they had healthy same-store sales in the U.S. Traffic was negative. As long as we continue to create jobs, I think they'll hold up just fine. But keep in mind that the weakness this quarter was really related to that lower income consumer, making $45,000 or less per year. They called that out. That was a little bit of a shift. So we got to keep an eye on that lower income consumer. We got to keep an eye on job growth. Job growth remains healthy. The lower income consumer is obviously feeling some pressure with inflation.
Peter, when it comes to the biggest challenge, obviously outside the slowing macroeconomic conditions, when it comes to McDonald's, how that positions them amongst rivals, what else is on your radar that maybe the street or other investors aren't thinking of when it comes to McDonald's and the plans that they have ahead here in the coming months?
So I think McDonald's always finds a way to take share because they've got better assets, more modernized assets. If you look at their base, they made investments in their restaurants in terms of modernizing them, bring them up to date in 2018, 2019, 2020. They really spent billions of dollars to get there, where many of their peers weren't able or couldn't do it. So I think that's what really differentiates them is the modernized restaurant portfolio here in the U.S. and really across the globe. But also their advertising budget is far far larger than anybody else's. So they tend to lean on both of those in these types of times to really drive market share gain. So I think they'll gain market share, although it might be at a slower pace than what we've seen in the past couple of years.
All right, Peter, Saleh, great to get your insight. Always appreciate you taking the time. BTIG Managing Director and Restaurant Analyst. Thanks, Peter.